At 6:18 on a Tuesday morning, you are sitting alone in a 24-hour diner outside Kansas City. The coffee is too hot. The vinyl seat is cracked near your left hand. Your jacket came from an outlet store 6 winters ago, and the server believes you inspect insurance claims for a living. Your phone is inside your pocket. You do not need to check it. Before sunrise, 12 dental offices renewed document destruction contracts. 3 warehouses paid monthly fire safety inspection invoices. A pavement marking crew started work at a distribution center in Omaha. 2 industrial parks collected rent. A generator maintenance company dispatched technicians across 4 states. By the time your eggs arrive, businesses connected to you have produced more revenue than the diner will see all month. Nobody in the room knows. They would never guess that the ordinary person in Booth 9 controls a portfolio valued at $259 million, not cash sitting untouched in one account. It is property, equipment, operating companies, contracts, debt, equity, and decades of decisions stacked so carefully that the final structure looks invisible. The server tops off your coffee. You thank her by name. This is what your money became. Not a sports car outside the window, but a system working while you eat breakfast unnoticed. It began 26 years earlier with paper. You were 27, working as a maintenance coordinator for a regional hospital network. The job paid enough to survive, not enough to feel safe. Most days were spent scheduling repairs, calling vendors, and explaining why something ordinary had stopped working. One afternoon, a locked bin full of old patient records sat in a hallway for 9 hours because the shredding contractor missed another pickup. The hospital complained. The contractor still sent the invoice. You stared at that invoice longer than you should have. The charge was not enormous. That was the point. It was small enough that nobody important wanted to think about it, but necessary enough to return every month. That night, you did not search for a revolutionary idea. You searched for used box trucks. You found one with faded paint, a rebuilt transmission, and more miles than confidence should allow. You used your savings for the down payment, kept your hospital job, and spent weekends collecting paper from accounting firms, clinics, and law offices. Your first route earned less than a talented salesperson could make in commissions. But the route repeated. Every locked bin represented another scheduled visit. Every visit created another invoice. Every invoice made the next month slightly more predictable. The first lesson was not that paper could make you rich. It was that predictable problems are more valuable than exciting ideas. Within 18 months, you had 2 trucks and 1 employee. By year 3, you had routes in 3 counties. You reinvested almost everything because the business was still too fragile to reward your ego. Then you noticed something. Your customers also needed fire extinguishers inspected, parking lots restriped, grease traps serviced, backup generators tested, and floors cleaned after everyone went home. Different industries. Same architecture. The work was unglamorous, recurring, and expensive to ignore. You stopped asking, what business would impress people? You started asking, what problem comes back on a calendar? That question changed your life. The first acquisition was a small fire safety inspection company owned by a couple ready to retire. It had loyal customers, aging equipment, incomplete records, and no real sales process. You financed the purchase with savings, a loan, and a seller note. For the first year, nothing felt passive. A technician quit. A major customer threatened to leave. An insurance renewal arrived far above your estimate. 1 month, the business showed accounting profit but almost no available cash. That was when you learned the difference between owning revenue and owning a machine that could survive. You standardized scheduling, replaced handwritten renewals, built a reserve before increasing your pay, and gave the strongest technician a reason to stay. The company did not become exciting. It became dependable, and dependable cash flow could support the next acquisition. A parking lot maintenance company followed, then commercial cleaning, then a generator service business with contracts tied to hospitals, grocery stores, and small data facilities. You were not collecting random companies. You were building a network around recurring obligations. The math changed quietly. In the beginning, your labor created almost all the value. If you stopped moving, revenue slowed. Later, managers, technicians, contracts, and systems produced cash without requiring your presence in every decision. That was the first real form of wealth you recognized. Money had stopped buying things. It had started buying distance between a problem and your personal time. At 41, the system nearly broke. A recession hit several markets at once. Commercial vacancies rose. Customers delayed payments. One acquisition had been made with too much optimism and too little margin for error. For 6 months, the portfolio looked successful from the outside and dangerously tight from the inside. You delayed expansion. cut distributions, renegotiated debt, closed one weak branch, protected the companies that still had strong contracts and honest demand. For the first time in years, you slept with the phone beside your pillow. The crisis did not reveal that your strategy was wrong. It revealed which parts had never been strong enough. Businesses tied to recurring compliance and maintenance held up better than those dependent on optional spending. Properties with conservative debt survived. Aggressive assumptions consumed attention and cash. You came out smaller than the forecast and stronger than the plan. After that, you stopped measuring a deal by what it could earn in a perfect year. You measured it by how much pressure it could survive in a bad one. That decision cost you several flashy opportunities. It also protected everything that came after. By your late 40s, the portfolio had become difficult to describe in a sentence. You owned service companies, industrial real estate, equipment fleets, minority stakes, and management entities connecting them. Some assets were fully paid off. Others carried carefully structured debt. Some produced strong cash. Others were valuable because of the land beneath them. Your accountant separated revenue, operating income, debt, taxes, reserves, and equity. You learned not to confuse them. A large portfolio can make a person look richer on paper than they are in cash. It can also produce more freedom than a larger salary ever could. The number was not the life. The structure behind the number was the life. Silence became part of that structure. You discovered that people do not need to be greedy for money to change a relationship. Sometimes they simply begin editing themselves around you. A joke becomes cautious. A dinner invitation becomes complicated. A business idea becomes a test. A gift becomes evidence. So you became selective. You did not pretend to struggle. You simply stopped volunteering information that did not improve the relationship. Your house is comfortable, private, and smaller than people imagine a 9-figure owner would choose. Your car is reliable. Your clothes are good enough to disappear in. The goal is not to look poor. The goal is to remain socially readable. There is a cost. A close friend once spent a year trying to raise capital for a small manufacturing opportunity. You could have funded the entire purchase without changing your lifestyle. You did not. Instead, you paid for independent due diligence without attaching your name, introduced him to an experienced lender, and helped him test the numbers. He eventually walked away. 6 months later, the largest customer left the business he had nearly purchased. Your money did not become his shortcut. It became the space he needed to avoid a mistake. He still believes the lender introduction was luck. You let him believe it. Years later, on another Tuesday morning, your accountant sends a portfolio review. The subject line is plain. Gross asset value, $259 million. You read the number twice. The equity is smaller because some assets carry debt. The value will move with markets, earnings, interest rates, and future decisions. It is not permanent. It is not guaranteed. It is not a vault filled with cash. But it is real enough to make the diner around you feel briefly silent. You think about the first locked paper bin, the used truck, the missed pickups, the months when the reserve account mattered more than your salary, the branch you closed, the deals you rejected, the years when nobody noticed because there was nothing visible to notice. You expected the number to feel like a rival. Instead, it feels like translation. All those ordinary decisions had been saying something for decades, and now you could finally read the sentence. The coffee had become payroll. The old truck had become buildings. The recurring invoices had become time. The restraint had become privacy. The boring work had become freedom. The server returns and asks whether you want anything else. You look at the bill. $11.80. You leave $30 under the mug, put on the old jacket, and walk past a parking lot whose maintenance contractor is one of your companies. Nobody looks up. That is not the tragedy of the story. That is the design, because the final luxury was never being recognized as the person who owned $259 million. It was being free to remain the person in booth 9. Subscribe for more stories about what money becomes over time.